There are four insurance moves every Michigan business owner should make before the year ends. Most owners I talk to have made one of them. A few have made two, almost no one has made four. And the ones who haven't are usually the most exposed. This isn't about adding policies for the sake of adding policies. It's about closing specific gaps. If something goes sideways before December 31st, will cost your business and your family far more than the premiums ever would. I'm Micah Brown with Legacy Financial Solutions in Petoskey, Michigan. Let's go. Here's what we're covering today. Move number one, let's protect your income. The income that doesn't just come from a paycheck. Move number two, we're going to talk about key person coverage, the kind your bank already assumes you have. Move number three is buy-sell funding, the agreement that's worthless without it. And move number four, the tax advantage cash value bucket, the one most CPAs don't bring up. Each one takes about 3 minutes. By the end of this video, you'll know which moves you've already made, which ones you haven't, and what to ask the next time someone tries to sell you a policy here. A note before we get started. I'm insurance license only. I'm currently licensed in Michigan. I don't sell securities. I don't manage portfolios. And nothing in this video is investment, tax, or legal advice. These are educational concepts. Specifics depend on your situation, and you should run them past your CPA and attorney before doing anything. All right, move number one. If you own a business in Michigan and you got hurt tomorrow, not killed, just hurt, what would happen to your income? I don't mean the revenue that's tied to the business. I mean the money that lands in your personal account every month. Most owners answer these one of two ways. The first answer is I have a disability policy through my group plan. That's usually a group long-term disability policy that'll pay a percentage of your W-2 salary. I feel like most owners I work with, W-2 is what you pay yourself is only a small slice of what it actually take home and put in your bank account every month. You've got distributions, K-1 income, owner draws, none of that shows up on the policy. You're insuring the visible part of your income while the bigger part walks out the door. The second answer is I have personal savings. I'll be fine. Maybe for a little while, but disability isn't a 30-day problem. Usually a disability that causes the financial pain we're talking about doesn't resolve in a quarter. It can go on for a long time, sometimes for the rest of your life. And the timing tends to be ugly. The same event that takes you out of the business is often the same event that demands more cash from the business, not less. Here's a move. If you look at how you're actually paid, total income, not just salary, and you put a personal disability policy in place that covers a meaningful portion of it. For high income owners, that often means stacking a base policy with a high limit specialty policy that recognizes K-1 and pass-through income. The carrier underwrites your full income picture, not just your W-2. Two reasons to do this before year end. One, underwriting takes time. If you wait until January, you're not enforced until March. And any health change between now and then can change your rate or your eligibility. Two, this is a policy you most want to qualify for now and need later. The healthier you are today, the cheaper this gets. Every year you wait, the policy gets more expensive. Hope is not a strategy. If your income disappears, the policy is what fills the gap. There's no other tool that does this job. Move number two. Here's a question I ask every owner who walks me through their balance sheet. If your bank reviewed your loan covenants right now, your line of credit, SBA loan, equipment financing, building financing, would they find a key person life insurance requirement in there? Most owners don't know. Some say no, then they go check. Then they call me back. Banks don't lend to a small or mid-sized business the way they lend to a public company. They lend to the owner. The owner is the business. If the owner disappears, bank's collateral disappears, and the loan they made becomes a problem they didn't price in. So they bake key person language into the docs, way down to the pages that most people never read. Sometimes it's an explicit coverage requirement. Sometimes it's a softer covenant that gives the bank the right to call the loan or repricing rates if a key person event happens. Either way, the bank has been thinking about this longer than you have. Key person insurance is a policy the business owns on the owner or whoever else if they walk tomorrow the business couldn't replace inside a year. It does three things at once. It gives the business cash to keep operating while a replacement is found. It satisfies bank covenants, which protects your relationships with lenders. And it signals to vendors, customers, and your team that there's a continuity plan. The amount isn't a guess. It's a function of three things. How much revenue or margin runs through that key person, how long it would take to replace them, and what the loan covenants require. Here's the year-end angle. If you take a new loan, refinancing an existing one, or expand a line of credit before December 31st, the bank is going to ask about this. Walking in with the policy already in place changes the conversation. Walking in without it gives the bank leverage they didn't have before. A buyer of your business will ask the same question. So will an estate attorney. So will the bank in 3 years when you go to refinance. Better to deal with the uncomfortable math now than comforting. Better to deal with uncomfortable math now than comforting assumptions until it's too late. Move number 3. This one applies if you have a partner. If you're a solo owner, skip ahead to move number 4. Although if you've ever thought about bringing a partner in, this is a playbook you want before the conversation, not after. A buy-sell agreement is a document that says what happens to a partner's share of the business if they die, become disabled, or want out. It's a beautiful document. Lawyers love drafting them. Owners feel responsible signing them. And about half the time, they're not funded. Here's what that looks like in practice. A buy-sell says if my partner dies, the business or surviving spouse buys their shares from the family at an agreed valuation. Perfect. Now go find the cash to do that. If the business has been growing and the business has to be at least somewhat valuable for there to be an agreement at all, the buyout number is real money. Could be hundreds of thousands, could be 7 figures. The surviving partner doesn't have it sitting in the operating account. The business doesn't have it either. So one of these 3 things happens. The deceased partner's family gets paid out over several years in installments, while the surviving partner is also trying to run the business. That strains both parties. Or the surviving partner takes on debt to buy out the family. The bank charges them interest, cash flow takes a hit, business slows down at the worst possible time. Or the agreement breaks down. The family wants cash now. The surviving partner can't deliver, lawyers get involved, the business loses years. The fix is straightforward. You fund the buy-sell with life insurance. Usually term, sometimes permanent, depending on the structure. Size to match the buyout obligation in the agreement. When a partner dies, the policy pays. The cash goes where it's supposed to. The agreement actually does what the agreement said it would do. 2 things to check before year end. 1. Pull out your buy-sell and look at the valuation language. Most agreements get drafted, the business grows, and nobody updates the valuation. If the policy was sized to a $2 million buyout and the business is now worth $5 million, you've got a $3 million gap. You closed half the door. 2. Look at the structure. Cross purchase, entity purchase, hybrid. Each one has different tax treatments and different policy ownership rules. The right answer depends on your number of partners, your entity type, and your basis. This is where your attorney and CPAs earn their fee. The agreement and the funding are not the same thing. A signed agreement with no funding is not planning, it's hoping. Last move. This is the one most CPAs don't bring up, not because they're hiding from it, but because it's outside what most CPAs are trained on. Permanent life insurance, whole life insurance, index universal life, and certain other structures have features most owners don't fully understand. The policy has a death benefit, sure, but it also has a cash value component that grows tax deferred, and when designed and used correctly, key word there, correctly, can be accessed tax advantage through policy loans. The second part is the one that matters here. For a business owner who's already maxing out retirement plans, whether it's a 401k, SEP, defined benefit, whatever you got, the question becomes, where's the next dollar of long-term tax advantage savings go? Brokerage accounts are taxable, you probably phased out of Roth contributions, and deferred comp inside the business has its own trade-offs. Permanent life insurance, structured properly, gives you a tax advantage bucket with no IRS set contribution limit. The limit is based on the policy design and the death benefit, not your income. A few honest words about this. This is not the highest return tool in your stack. If you want maximum growth, this is not it. The point is tax treatment, access flexibility, and predictability, not chasing market returns. It's also not free money. It's not a magic strategy, and the policies that got sold this way are often poorly designed for cash value. A policy designed for death benefit and a policy designed for cash accumulation look very different on paper. Make sure the person selling you knows the difference. Their insurance products, guarantees, where they exist, are limited to the contractual guarantees of the issuing carrier and depend on that carrier's claims paying ability. Any returns illustrated are hypothetical and not guaranteed unless explicitly stated in the policy itself. The year-end angle here. Cash value policies are funded over time. The earlier you start, the more efficient the policy gets, meaning for every dollar you put in goes to cash value instead of policy cost. Starting in November versus starting in March of next year doesn't sound like much. Over 20 years, the compounding difference is real. Same as move number 1 here. Underwriting matters. Healthier today is cheaper today and cheaper for the life of the policy. This is a long-term tool too. Treat it as one. So those are the 4 moves. Income protection, the policy that covers your real income, not just your W-2. Key person coverage, the policy your bank already assumes you have. Why self-funding, the cash that makes the agreement actually work. Tax advantage cash value bucket, the long-term tool most owners don't know how to ask about. If you made all 4, you're in the small percentage. Good. If you made 1 or 2, that's normal. The rest is the work. If you made none of them, that's a conversation that matters most. Truth early is cheaper than stress late. Here's the year-end checklist. Comment or DM me the word blueprint or DM me on Instagram, and I'll send you the 4-move checklist as a PDF. It walks through each move, what to ask, what to verify, and the order to do them in. No charge. Same document I use to start the conversation with owners who book a call. This is educational only. Not advice for your current specific situation. Insurance carriers offered in Michigan only. If this video was useful, the next one breaks down move 1, income protection, in detail. Thanks for watching.